Today, I will talk about bonds. I will explain what yield, rating, and maturity mean, and then we will look at a few types of bonds, which are government, corporate, and fallen angels. Then we will review a few charts, and we will evaluate them and see who are they for. So, to do this, I will also utilize a Word file because I want to write some things down, because this is some of it is quite theoretical because we will get into finance as well. But the first thing I want everybody to be aware of is that a bond is not an investment. Okay? It is a promise. It is a promise that has a chance that it will be broken. Okay? But until it is broken, this promise says that you will be paid a fixed amount of funds, a percent, on a fixed schedule. All right? So, promise to pay a fixed amount, a percent, on a fixed schedule. Okay? So, with this in mind, bonds are connected with yield, credit rating, and maturity. And the only reason these are present is to price how likely the promise that we're speaking about is about. It could fail, basically. And if it were to fail, the bond, the promise, how painful it would be. So I want to show an example. Let's say I need $100, 100 USD. So if I need $100, I will, not really, but theoretically speaking, to describe what a bond is, I need $100, so I issue a bond. Okay, let's say it has 5%. Well, let's make it 10%. 10% yield on the bond. And that's because my credit rating is very bad. What could it be? Let's say triple B. Credit rating is triple B. There are a few types of credit. Well, quite a few types of credit ratings, basically. They start from Ace and they go down. But nevertheless, let's go with that. And the maturity is 5 years. And I will explain this is a very easy example to understand once you hear it, you will fully understand. So you buy this bond. You want to loan me $100, so you buy, what am I writing? You buy the bond from me, and so you give me $100. Give me 100 USD. Basically, that's how straightforward it is. However, because you've given me this 100 USD, now I have to pay you 10% every year. Okay? So that's what it's not rocket science, it is $10. 10 USD I pay annually to you. But we have what? The maturity is 5 years. I didn't even explain this properly. So maturity is 5 years. So that means that every year I pay you 10%, which is in our example $10. And after 5 years, I repay the full amount. So in total, I pay you back 150, right? So 5 years times 10, 50, and the original $100 I pay back after the bond has matured, which is 5 years in this example. But that's what maturity is about. Sounds cool. Well, of course, I may not do that. If I keep my promise, basically, I might become bankrupt, or I could disappear. I might not care. So that's why we have the yield, because because I have a low credit rating, in order for anybody to allow me to borrow funds from them, the yield must be high. And because it is high, it's a risky investment. So I might not pay it. Of course, if I don't pay, there will be more issues, but this is not the topic that we will discuss about. But that big if, the if actually, is basically it's what bonds are all about. This is the key structure of what a bond is and why it exists. So from this, you need to understand bond yield, right? The return on capital. Capital is not a proper term, capital invested. And this is not just about bond. I mean, in this case, bond yield, yes, but generally yield is the return on capital invested. The other thing that we mentioned was maturity. Well, credit rating was the first one. So rating, obviously, this is even as individual investors, or we all use bank accounts, so we have a credit rating basically. So this is the assessment of worthiness or the ability of a person. In our situation, it's a corporation or government to pay. Even corporate, no, doesn't exist. Okay, corporation. And the last one that we got is maturity. Maturity, I believe, is only used in bonds, really. And this is the agreed upon year or date, usually. So when bonds issue bonds, they say it's a 5-year bond or 10 or so on. But then when you go into the market and want to buy bonds that are already created, usually they show the amount of time that is remaining. So the maturity then is showed as time remaining. Okay. So this is the basics. This is something that it's very easy once you understand it and read it. And I'm not giving you everything. If you want to know more, you really should read more into it. But the basics, as soon as you know the basics, then you can ask questions. And this is where you really start learning. So let's start with the first type of... Why did I make this boat? It's annoying. Okay, let's start with the first type of bonds. Okay, so we will speak about government bonds first. What is this? Right? A government bond is a loan. It's a credit. It's a loan to a country. And it's very important to remember, I'm all about politics or lack of politics. This is a loan to a country, not a government. Very important to say this because government, all right? Very important to say this because we have all observed governments that are very quick to borrow cash, and then other, let's say, political parties will complain that's not right, we shouldn't do that, and so on. But it doesn't matter because if a loan is taken out, they must repay. There is no, you cannot default. Well, you can, and you will see examples of this later on. But if you do that, then let's discuss this down the road. So not a government. Okay. So governments change, and that's fine. That doesn't affect bonds. Just because a government changes doesn't affect bonds. And that's because the obligations of the debt that has to be repaid doesn't change. Debt obligation doesn't change. Okay? So the key thing to remember is that a bond, it can only be as safe as the country's ability to pay, or willingness even. If a country is not willing or does not have the ability to pay, actually, there is a good example I think you can review that happened recently. Let me quickly note this down. So what did I just say? Country's willingness or ability to repay. I want you to review Argentina example, and the reason why I'm saying this is because Argentina default risk, I think there was They had elections in 2025. Yeah. Okay, so yeah, debt, but also negative central bank reserves. But then, yeah, the president conducted some reforms, and the USA also invested some cash into their currency. I did not mean to open Visual Studio Code. Okay, let's get back to it then. So, yep, review this. This is a very interesting example. I was really following these events as they were taking place. But yeah, so we've got the government bonds. Key thing, government bonds are as secure as the government is. Nothing more, nothing less. And the reason for that is they've got, basically a government has a lot of ways to raise cash to pay back loans. And can you guess which one it is? The first one? The easiest way for a government to raise cash? Yep, you guessed it, or did not. Oh, okay, I'm writing in bold, but this is still valid because raising tax, let's do that in caps lock. Okay, tax. This is something that we all hate. I don't like it. You don't like it. Nobody likes it. Governments love it. Or they can raise tax, or in some case, and I think a lot of us Europeans especially can attest, invent new tax. There is a tax on what now? Now I cannot even mention one, but there is a tax. We've got a carbon neutral tax. So some of the petrol companies, basically, they have to buy carbon bonds to offset carbon emissions, some things like that. And then we have to, at least in a lot of countries that I know, you have to pay tax for your vehicle if you have a car. But then if you want to travel, you should also pay a specific road tax. So if you want to go down a big motorway or highway, you have to pay a specific tax for that motorway. But I digress. This is not where I wanted to go. Yes, I love taxes, as you can see. So yeah, they can raise or invent new taxes. Oh yes, a new. This is a beautiful example. I read about it just yesterday. I didn't know it was real. So tax on unrealized gains. This is something that shocked me. Can you guess where this is? No, Germany. And this is the only country that I just read about it a few days ago. So it could be that the majority of countries do that. But I know that there are some countries that are discussing paying tax on unrealized gains, which means if I buy 1,000 shares of NVIDIA at $1 and they go to $2, so my unrealized value is now plus $1,000, so my total is $2,000, but I have to pay the tax on it, even though I haven't sold, so I may not even have the money. And yeah, there is another example that I just recalled from the UK where there is some tax on inheritance tax. So let's say if I don't want to go down the road of inheritance and all that. Okay, so tax raise, but that's not the only one. So see, even here, just for raising or inventing taxes, we have so many examples that we can discuss, but they can also control currency. And this is easy again. And we see this happening all the time. How do they do this? Well, most times, not all the time. I live in Europe, so my country uses the euro, but my government alone cannot control currency because it's managed centrally by the European Central Bank. Very much in the way that New York cannot change its own currency, control the currency. And by control, I mean, I should write this down, raising or, well, changing, basically it's just changing rates. So that's that. But again, not every country can do this even. So some can increase or reduce interest rates. They can print money. Print money is real. Okay. But printing money is also a bit, okay, it is misunderstood because, well, this is the topic that I shouldn't get into. But printing money is not It's not black and white always, because there are two types of that really that take place. But when we get back to, we'll discuss this further on. So, okay, currency and basically tax. This is a lot that governments can control, just about all governments. So they can create new money, basically. So they do not want to default on the bonds, on credit, because it destroys. If you give me the $100, right here, you gave me $100. If I don't pay you back, you're not gonna give me $100 in 5 years, or if you give me $100, then you might demand a 20% yield. Actually, this is a good example, because I think that if you Google around October, perhaps the USA tried to sell some bonds, or it could be even November, and they couldn't. They had to increase the yield just to sell them. I could be wrong, but it was something similar. But you get the point of it. Governments don't want to default. They don't want to defaulting, basically. Let me put it here. Default equals bankruptcy. It's a different mechanism, but it's just, oh, what's wrong with my England land today? Well, it's the same thing, basically. They don't want to default, because that reduces their reputation, destroys rather reputation, and they won't have credit worthiness. So future investments just might not happen. Future investments may not take place, because the reputation of the country is now basically gone to crap. So the yield might have to be very high. And if governments start doing that, then people will protest a lot. They will protest a lot. So again, Argentina, if you're interested in this topic, review it. You can also Greece. Greece is a good example, because they defaulted. They defaulted on, well, that was very many years ago. Default on debt, yeah. So Greece defaulted. 1.6 billion payment to the International Monetary Fund. Okay, cool. Well, not cool, but there are a lot of examples that you can look into. But I don't believe you need to do that. Not specifically in terms of how countries have defaulted in the past, but you should be aware that it can happen. But it's very unlikely in the Western countries for that to happen. But then we've got what? Risks. Because we spoke about loads of things, but we didn't really talk about risks. We showed here how they can obtain more money to pay. But risks, and there are a lot of risks. And again, you can read about Argentina or Greece to see what happened there, but the default risk still exists. I wouldn't say so with Greece to the same extent as before, probably not even at all, actually. Because actually Greece is, I believe the GDP growth for Greece has been pretty stable, while spending has decreased over the last decade, but it's irrelevant for our conversation right now. So risks, currency risks. Okay, we just discussed this. We've got, well, currency / inflation. Okay, because they are connected. It is a risk, because if there is inflation but the country cannot control currency, then they cannot do anything about inflation. Because when we have inflation, countries need to increase rates, interest rates, that is. So when we know this here as a risk, what I'm really referring to is that, let's say it's a recession or whatever, the country needs to, or even if it's normal days, let's not get into the extremes of recession. So let's say the USA, they're finding it hard right now to pay back their debts, so they can just print more money. Printing money is not cool. It makes the stocks go up, but it makes the bonds go down, because you will get paid, but the value of money that you get paid, imagine the value of, let me finish my sentence. So the value of money that you get paid is actually less. So imagine you give me the $100. Well, that's not a good example. let me give a new example. Let's use the same thing again, basically, but let's say I'm the USA. I am the US government, and I have 1,000 GDP, okay? My every year, so my GDP, gross domestic product per annum is 1,000. I have to pay what, 100 USD annually for debt. I can print money. I print money. And this is not the exact way that it works, but it's a very good example, really. Not a true example. It doesn't work that way. But it describes basically what happens. The end result, rather. So I have $1,000 to start with. Every year my GDP is the same 1,000, but now I print money. I have 1,000, 1,100 or 50, whatever, really. They're not printing that much, but as a rough example, it's fine. I have $1,100, which means that I can still pay you. I can still pay back $100, but then I also have the 1,000. I still have 1,000 USD, which is left to pay pensions or roads or healthcare, right? So it means that I'm not going to have austerity measures. I'm not going to say, right, we're cutting healthcare, or we're not going to fix roads or pay pensions or increase pensions. So you get it. So printing money for stocks, it goes up because that's new money. But it's not generally good. But yeah, this is something that happens every 5 or so years from what I have seen. They can print the money, reduce rates or increase rates. But if they reduce interest rates, that means the access to money is easier. So again, the value, this is what is happening now actually. The value of the USD is going down compared to, and we have seen this in previous video charts, where Euro funds compared to US funds, even though they're tracking the same stocks, the Euro has not moved at all, even though the US S&P has moved by 13%, I believe. But okay. Now, why do I keep pressing random buttons? So the other risks that we have is what? Political, of course. We have political risks, which I'm not going to discuss a lot, but they do have real, they can do real harm. So you can see governments that are sanctioned, or regime changes, or government changes to extremes. Do you know what there was this lady in the UK, what was her name? Liz Truss, or Truss, Liz Truss from the UK became prime minister, and I think she was a prime minister for only, I have to find this out actually, this was hilarious. Liz Truss, PM UK duration, a week? No, 45 days. So she was the prime minister of the UK for 45 days. So you can imagine what happened. 45 days. Gilt, UK bonds, gilt went ballistic. Nobody had trust in her. She came out with outlandish ideas that, well, they were outlandish. That's all I'm gonna say. Very interesting. I'm going to bold this again, because this will be interesting for you to read. This is how you build knowledge. I don't even know how I came to know things about bonds. I don't like bonds. But there is a place for bonds for everybody, basically. So rather than ranting about, this is all that we've got to discuss when it comes to government bonds, okay? We've covered everything, really. So the most important thing is, let's say, generally, for Western countries, it's safer, okay? They're not going to go bankrupt like Ghana or someplace. So let's say Germany or USA. Yes, the USA have a lot of debt, but they're growing a lot, so it doesn't matter. Japan is also notorious. It's also notorious. Well, I'm not quite sure if their growth is not really there, but they're paying back, so who cares? But I'm gonna leave this out actually. But it depends which countries you buy bonds of course. So the default risk for these countries are low because these countries will never ever go bankrupt or say they are defaulting their payments because they will be hammered for ages, and these are leading countries. Not gonna happen. So with that in mind, the real risk is what then? If it's not default or bankruptcy, what is the risk? The remaining risk? Yes, political, but we are not gonna get any IRGC type of leader or Xi Jinping that will govern a Western country. So what is left is inflation, and we already know they can control inflation through monetary policy. Policy, right? Very good. Monetary policy, interest rates, basically. Interest rates. Okay, I've got a new keyboard because the previous one broke, so it's a bit odd to type now, and it's very loud, so perhaps you will be able to hear it. So interest rates. So yeah, these are safe. Currency risk and inflation risks are the only ones that should really look out for. But when you invest in bonds, you don't care. I mean, no, you do care, but you don't buy a bond and then look at what's happening in the country every day because you want to make sure your bonds are okay. No, if you buy US or German bonds, you're gonna be all right in terms of not losing your money. So I will put it this way, actually. Government bonds. This is a good example. Government bonds. They are like airplanes, okay? Airplanes. That's funny, but they are really like airplanes because they are safe, right? Airplanes are safe until the rare moment they are not. They are not. So when an airplane drops, you know what happens. It's horrific, absolutely horrible. The consequences are massive. Well, and this is exactly how I should even note it. Consequences are massive, negative meaning. This is what key thing you should remember. Like airplanes, they are safe until they are not. But when they are not and they go down, when you know what hits the fan, it's horrible. It's ugly. So that's the only thing that we should really understand about government bonds, unless you want to do further digging, which is I do encourage, by the way. But that's all for government bonds. Then we've got corporate bonds. What are they? They are the same as government bonds. Same as government bonds, okay? That means that you've got the same type of promise, everything is the same, but the difference is that the promise is made by a corporation, not by a country. A country. So this is where we really want to understand the risk better, because understand risk better. Because the reason for that is because companies can go bankrupt. More companies go bankrupt than countries do, obviously. But they can even just lose revenue or fail some payments on time, and they can really go down the drain. Corporate bonds pay much better than government bonds for that same reason. These pay better than government bonds. Okay, that's true, but because there is a bigger risk, so they don't control currency and they cannot tax citizens. Thank Christ for that, right? So they cannot alter anything around them. They can only sell their products or services, and that's about it. So So basically the yields that you would get, and we will have a look at some examples. I don't know what the yield is. Let's say a government bond is 3-4%. Let's say the USA. A corporate bond might be double that. It might be 8%. Actually, there are some companies like Oracle or CoreWeave that have 10% bonds even. But that's because there is a higher risk. So that's why the yield compensates for business risk, which could be an earnings drop or industry risk. Anything related to sector. Do you know what this? Cigarettes. No, I'm not asking for cigarettes. Altria bond yield. Well, so look, 7%. This is not a bond really, but this is a beautiful example of what I'm explaining. So sector risk I was mentioning. So this is where the entire sector is going down the drain. It's not growing. It's not being more productive than the past. A great example of this is cigarettes, because they've been banning them, increasing prices, all sorts of places. Western hemisphere at least, Europe, USA, and so on. Asia, I'm not quite familiar. I think it's still kind of growing, but that's why when you buy shares of Altria Group, you are getting 7.67% dividend yield. That's a lot, and you can see what is the stock price. How has the stock price been over the last few years? I'm not gonna check that now actually. And the other one is I was thinking Phillips Morris. Phillips Morris is another one that is in the same business sector, and they also pay a good ratio. Well, a good yield rather. But yeah, sector risks, earning risks, and so on, as we were mentioning. So that's why they are with higher yields, basically. But then even though they are higher risks because of that, they are still treated as investment grade because they are still profitable. Basically, if you get 6-7% yield from a bond, it's highly profitable, technically speaking. It's profitable and stable. It's absolutely stable. But some are even higher yield. So they are junk companies, basically, with really, really bad balance sheets. They don't own anything, or they're very leveraged. They have a lot of credit. But this is very short because it's the same as the governments. It's just higher risk. Well, not much risk, but still higher. And you can buy individual corporate bonds, or you can buy funds. And I will show a few funds after that you can look into as well. But the last one that you've got is not corporate bonds. They are still a type of corporate bonds, but fallen angels. Same as government. But this is where it gets interesting, actually, because a fallen angel bond is a corporate bond. So corporate bond, it's the exact same thing. But the difference here is that it used to be, if we mention here that investment grade, so high return and so on, corporate bonds, same as fallen angels. What am I writing here? Same as corporate bonds, but downgraded to junk. This is important for you to remember. So they're downgraded to junk. And actually, this is extremely important because guess what the names of such bonds are? High yield. I'm just writing that here that it's a trap because I don't want anybody to see this and say, oh, wow, high yield, that's amazing. But it's not. Well, it is. Depends on what your viewpoint is. Everything can be good or bad depending on how you look at it and what the context is. But the reason why this happens is, note Oracle review bonds. If you can do some search on Oracle bonds, very good example. They've got a lot of debt right now, and their bonds have been downgraded to junk as well. So and this happens because either earnings results have been poor, or the whole industry has seen a massive downturn, or it could be that the CEO has suddenly retired, or unfortunate accidents have taken place with management or so on. But the most interesting, these are really interesting, it's true. The most interesting part is that as soon as they are graded, guess what happens? As soon as they are downgraded, big funds have to sell them. Pension funds, mutual, all types of funds that contain that, and just about all pension funds, especially in Europe, they contain mostly bonds. I'm not saying they're corporate bonds, but could be a mixture. I don't know all the pension funds, but legally required to do so because of risk. So if you remember, I will write this down as well. 2007-8 crisis, US people lost their pensions. Right? We don't have that risk in Europe. But guess what? We also don't have the same growth, because if our spare cash for pensions goes into funds that basically have bonds, then they don't grow as much as stocks. But we will never lose them. Well, not never, but a lot of promises have been made, right? So legally they cannot own them. They're basically junk. So pension funds, all the countries have laws that say you can't hold crap, because we don't want our people to lose their money, because then we will have to pay our citizens, and countries don't want to pay citizens anything, right? So yeah, basically they cannot own them. So price of these bonds drop, and the yield, the percent that you get paid annually, that goes that goes up massively. Well, not hundreds times, but yeah, let's say it can go to 12 or 13%. I'm only guesstimating here. So basically the bond gets punished. When that happens, the bond gets punished as if bankruptcy is imminent. But that's not the case. It might not happen. The bond, the price and yield spike will change massively as if they're going bankrupt, even if the fundamentals of the company have not changed really. So when that happens, some of them, they can recover. A lot of the bonds recover, but some don't, and some go bankrupt. Everything you can think of, it has happened and will happen. But it's still okay, as long as you know the risks, right? So let's finalize the risks, because I have been yapping for I don't know how long, probably 20 minutes, which will be funny, because when I stop recording this and see the video, it will be 135 minutes long probably. But let's compare risks, okay? Government, corporate, and fallen. Well, I don't know if it's worth it to write the separate fallen angels, but yeah, let's a one-liner, because I want it to be short. I want it to be short, he said, as he wrote down 353 words. So bonds, government bonds, let's start with those. Lower yield we saw, because inherent risk is arguably lower. So in my opinion, and I wanted to show this with graphs, but we will do that after that, they hurt you massively, but through inflation, okay? Because imagine getting paid for 3% per year, but inflation is 4%. Pretty crap. But let's not forget, risk is low, because I don't want to talk again about currency and all that. So I'm control, tax. I'm just going to highlight some words here because we discussed them and we did note them. So pretty safe. Don't buy Iran bonds right now. Right? This is a joke. Well, actually, I don't know. I'm not saying not to buy. I'm not saying what to buy. Make up your own decision. Should probably stop joking as much. Corporate bonds. What were the risks here? Do you remember? Of course you do. So, well, before we get into the risk, higher yield. This is something that we like about corporate bonds. They are higher yield, usually. And they can hurt you still. But how do they hurt you? They can hurt you suddenly because you get hurt holding corporate bonds when companies go bankrupt. Right? Bankruptcy. This is very important. Keyword to remember. So we've got higher risk basically, and that's why you get the higher, not higher inflation, but you get, well, you don't have inflation risk, lower inflation risk, because we don't care about inflation risk here, but higher currency risk. Okay, well, higher general risk. Sorry, why am I thinking about currency? I read a very interesting article about Swiss franc. That's why. So it might be, Swiss francs apparently might be performing really well this year, but I don't really trade currency, so it doesn't matter. Let's get into the fallen angels. It sounds beautiful, and it really isn't beautiful though. Fallen angels. Higher yield, well, highest really. Highest, let's note this down. Highest yield. I don't know how much highest. I think I know some examples, but I really want to go into the funds that contain these fallen angels and other types of bonds, because institutional investments or well, if you put your money in a bank for a fund, they won't buy. Well, they will buy individual bonds, but you're not going to pick them. So why bother looking at individual bonds? Not needed when you want to put your money there. But again, I'm not gonna call it investment because it isn't. But yeah, we've got highest yield because highest uncertainty. Uncertainty written in the absolute most uncertain way. And again, bankruptcy, all that beautiful things. So they can hurt you in this way. Hurt you like that, and well, they can hurt you in always, really. Even emotional hurting. Emotional damage. Because when you buy these and you hope that they will be, they were downgraded, so you buy them at a massive discount, so you hope that they will be upgraded again. So they can hurt you. Emotional damage. I think that's a very nice way of putting it, and polite as well. Okay, so this is it. We've got fallen angels, corporate bonds, and government bonds. Let's find out. So TLT, I think, was the USA one, but actually we need to compare it against something. Let's compare it against, not yet them. Let's compare them against the S&P 500, and we have to look at total return, because we're talking about yields, and basically a yield is a dividend, so we want to make sure we're properly comparing apples to apples, not apples to mangoes, or so on. Nevertheless, 7-year bonds, IEF? Well, IEF. I'm not very good with ticker names, so I share score now the second one. Ticker symbols rather, not ticker names. IEF. What we're looking here is the US bonds, which are 7 to 10 year old. Well, first of all, S&P 500. Okay, you can, what do you see here? A massive outperformance, right? We can see that for 10 years, well, if we change it for 10 years, we have done 15% compounding annual growth rate, which has returned in total 323% compared to 12% of medium-term government bonds. Okay, this is nothing to write home about. Not the best type of investor here if you buy these, but it doesn't matter because so the S&P, first of all, is a great benchmark. It has outperformed the whole world in the long run. So when you compare with them with IEF, the short-term, medium-term rather, 7-10-year-old bonds, they are considered very safe. And I mean, they are, because in terms of default, which, as you know, failure to pay, it's not going to happen. Low risk of that happening. So that doesn't mean that it's okay, though, because this is where it gets contrary. As you can see, safe does not mean high return. No, they have barely done anything, which isn't a bad thing. I'm just noting it. So low yield, what is it? Yield percent. So trailing yield, which is the last 12 months, is 3.76%. That's the average, okay? Remind me tomorrow. Yeah. So, yeah, we've got low yield, and what really strikes me from here is that this is when COVID hit, I think so. But actually, I want to change it to 5 years, because look at what happened. This is what caught my eye. From 2021, this is right after COVID, or around that time rather. This is where, in the USA at least, and these are US bonds, so it's a great example, interest rates went up. So the bond yield went down. Oh wow. Look at that. Oh, they're minus 7% actually in the last 5 years. Wow. Okay, nevertheless. So yeah, we've seen this, okay? These are in the medium term government bonds. You've got TOT, you've got different types, okay? So TOT bonds, these are 20-year treasury bonds. I'm not going to discuss all the duration type of bonds, but I want to discuss the different types of bonds. So these are government bonds. Let's, for the fun of it, wow, they haven't done much better than, but so these are TOT's 20 years to maturity bonds. So they are much safer because the government, the country, has 20 years to repay you. I mean, a country can go bankrupt, but in 20 years, probably they'll be all right. But it doesn't matter, because we're not looking into all types of US bonds, in terms of duration at least. Let's look at corporate bonds, and I know the ticker symbol for this, HYG. Not that, this high yield corporate bonds ETF. Remember, high yield doesn't necessarily mean it's, well, what is it actually? HYG yield tracks the result, blah blah blah. What is the dividend yield? 5.7%. It really looks measurable, but when you compare it against the 3.4%, 5.7 is like 70% more. So where is it? Why can I not see it? Oh, this is embarrassing. Come on, I want to see it. Bugger me. This is an embarrassment. Corporate bonds, ticker symbols. ETF. Vanguard short-term corporate. Whoa. Yeah, let's look at intermediate, because I'm looking at this because the bonds that we compared for the government bonds were 7 to 10 years, so we don't really want long-term bonds. Wow, look at that short. Oh no, this is not bonds. Yeah, let's look at VCIT. So this is intermediate term corporate bonds, VCIT. So this is going to have a total stock market index fund. No. Okay, here it is. This is why you should read, because if I had just clicked the first one, then it would have been total stock market index. So all wrote and all that. Removing the green didn't work before. So now we've got... No, we don't have it. Why? This... What's going on? Does everything that I decide to review suddenly get deleted? This is not going well. I'm not proving my point. High yield corporate bond. Load? No. Okay, I will then just get into the fallen angel stocks, because I don't see this working out. No, doesn't load. I don't want to waste time looking at other tickers. Come on. Do it quicker. Just ETF fallen. Okay, yeah, I've found it somewhere else. We're not gonna have a lovely graph, but it doesn't matter. It's still, I think we can compare. We can compare them. How do they? Where is the comparisons? Not brokers, ETF comparisons. So if, well, fallen, what? I just found it. Okay, this is turning into a tutorial how to do a basic Google search at this point. This is embarrassing. Fallen ETF, just ETF. Here it is. Okay. So let's look at the performance. Wait, does the performance include dividends? I don't know. Is this accumulating? Yes, so this is accumulating. You don't get paid the dividend. It just gets reinvested. So over the last 5 years, it has returned 21%. Not great. And what was IEF? Oh, this is not working. So 21%, and IEF was I can't figure it out. This is embarrassing, but okay, nevertheless. Where I was going with this is that we saw government bonds, how they performed relative, at least, to the US SP 500, and how the lack of, we saw stability, basically. And we weren't able to see HYG and Fallen Angels, which I really wanted to, but I looked at those ticker symbols before, because I don't know ETFs for bonds. I've never been interested. So I saw them and I was very surprised. But the corporate bonds, were as you saw, the return was almost double that of the government bonds. So these performed better, but the Fallen Angels, they did not perform much better than the corporate bonds. I mean, they are corporate bonds as well, but higher risk corporate bonds. So over the 10 years, I only looked at 10 years, the return was a bit higher for fallen angels rather than standard corporate bonds. Obviously, both of them still outperform the IEF, which is the 7-year maturity US bonds. But basically, I mean, there's no way to put it other than over 10 years, the stocks won. We saw 380% S&P outperform. So that's a lot. And if you look at my other videos, you can even see that there are other funds that performed much better than the S&P 500. I really don't know what's going on with this. It doesn't want to work. It's trying to sabotage me. But yeah, I mean, so obviously stocks will outperform bonds. Okay, that's fine. Fallen angels came second, which is fine. Again, corporate bonds followed, and then government bonds. Okay, last. That doesn't mean they're bad. Doesn't mean they're bad at all. But we saw 12% for the government bonds, the 7-10-year-old, 12% return government bonds, 10 years. What does that scream? What does it scream? To me, it screams barely protecting any capital. Barely protecting capital. What was the inflation for the last 10 years? Cumulative inflation, 10 years. Cumulative inflation, 10 years. USA, yes. What? 37%? Jesus Christ. I didn't expect. What? Cumulative inflation, CPI, significant, blah, blah, blah. $1 in 2015 is now 137. Roughly 36. Oh, crap. That's a lot. Barely. So, wow. 37% cumulative inflation in USA since 2015. Oh, it doesn't matter if it was 2015 or 2016. I mean, that's not the point. The point is that it's horrendous. Okay. That's that. What are we? Well, not for who. What are who? Well, who are bonds for, or who? Well, or what? Doctor Who? What? What did we see here? Just over here, even we can note it down really quickly. Bonds are not for what? They're not for getting rich. Getting rich, right? I don't think they are. They definitely don't beat the S&P, so they're not for they're not for beating benchmark indices. SP 500 is the example that we observed. I mean, not long term at least. They could be. I think that if you break it down granularly for 1 or 2 particular years, you can kind of find brief moments of outperformance from bonds, government bonds. And they definitely don't make you feeling smart. But I'm not gonna write that down. That's not important. Bonds are for who? What do you get from bonds? You get the yield, which we saw was smaller than inflation, but there is a scenario where you care more about yield than you do inflation. What is it? I can give you one. If I have $1 million in the bonds that we, what was it? Government IEF, the 7-year-old bonds. They're not 7-year-old, but the maturity date rather, and they gave almost 4% return. So that means if you have a million, you get what? You get $40,000 per annum, and that can be a lot. It could be barely anything. I don't know what your lifestyle is, but it's for income generation. And if you're 80 years old and you have 2 million, you're gonna probably be all right with that. If you just stay at home with your wife or something like that. Don't know how much toys you'll be able to buy for the grandkids, but it's for income generation. That's what it's for. Or cash flow stability, if you want to call it that. What else we saw? I know that we only were able to observe this for, bugger me, for a brief few minutes, but what we saw was that they were pretty bonds. Really? Bonds? No, I meant bonds. The bonds were very controlled. They didn't have any spikes, massive spikes like the S&P did. So it's for volatility. Volatility can bring a lot of upside, as we saw in the SMH ETF in my previous video, which was something that I really enjoyed doing. But if you want income generation, you don't want volatility. You don't care about that. So that's why you buy funds, and which also affects your psychology, actually. Psychology or survivability. You don't care if something bad happens because you're getting paid no matter what. You're not gonna outperform, but that's not the idea. This is not an investment. Yeah, that's about it, really. I want everybody to be aware that everything that we have noted down here, you should do your own research. I gave a few examples, but there are a few examples where, not examples, but a few notes, like Liz Truss became PM of the UK for 45 days. The UK bonds, they went ballistic. Look at Argentine. That was very interesting what happened. Try to find in your countries what absurd taxes they've got. I will be deeply offended if my country did this to me. I won't be able to do anything about it, of course, but it should be unlawful. There should be a United Nations alliance against such taxes. It's not right. Yeah, nothing else from my end then. I'm gonna close it down. Thank you very much, and thank you to Dragan, because he was the one that suggested I create this video. So it was a pleasure to do so. Take care, keep safe. I will put this in the description, and we'll see you next time. All right.